Hello, everyone. Can we just double check that you can hear us? Can you put in the chat or the questions that you can hear us loud and clear? Loud and clear, brilliant. We'll just wait a little bit longer for some few more people to join, and then we'll get started. Okay, we've got around 50 people in here now, so I'll just give a bit of an introduction and I'll hand it over to Stephen, who will be taking control of the webinar. It'll be about 45 minutes long, and then what we'll do after, he's kindly giving us some time at the end where you can ask him some questions, and we could do a bit of a Q&A for 15 minutes at the end. So hold fire on your questions till the end, and I'm sure we'll get through most of them. I want to welcome Stephen Goldstein to the webinar today and thank him for giving us his time. We do value his content, and we hope that you guys do as well. Just a note on, if you are getting phone calls from us, we do have account managers in the UK. So we're not badgering you for anything other than to help you with your trading. And hopefully, this webinar can reiterate that. We want to help you improve as traders. So if there is anything in particular you want to work on, you can go to your account manager, and we are here to help. So I'll hand it over to you, Stephen.
Okay, thank you, Chris. And thank you, everyone who's listening, and Capital.com for giving me this opportunity. So the title of this webinar, Developing Peak Performance Trading, and it's basically about powering your performance by developing the how to be of trading so you can be better at the what you do of trading. So let me just give you a quick introduction to who I am, so you've got a kind of sense of some context behind some of the things I'm going to talk about. So I work these days as a performance coach to traders. I've got clients across the world. Many of them are in hedge funds, investment banks, asset management firms, energy and commodity trading businesses, prop firms, and I work with a lot of private retail traders as well. So it's a pretty broad spectrum. I was a trader myself for nearly 25 years, starting in the mid-1980s up to 2010. I worked at a number of investment banks, including Credit Suisse in London, Commerzbank in London, and the investment banking arm of American Express. I am also the co-host of a podcast series called the Alpha Mind Podcast, which you may or may not know. And we focus on the psychological, behavioral, and emotional challenges of trading. We've been going for just over 2 years. We've produced about 80 episodes, and we've had some amazing guests on in that time. If you want to go and check us out at some point after this, you can go and do that. This presentation is given through my own company, Alpha R Cubed, which you'll see the name on this podcast. Just to let you know, I'm not specific to any particular style of trading or market. So when I work with traders as a coach, I don't work on their technique or their skills in terms of how they analyze markets. I work on them, the person as a trader, the person as a risk taker, and their risk process, which means that I can trade right across the spectrum of all products and all markets, foreign exchange, fixed income, that whole global macro space. I coach people in equities who are perhaps long only or even long short traders. I work with people in the energy and commodity space, people in credit, people in crypto, really every single market and every single market style, from very short-term day traders to long-term investors to systematic traders, quant traders, and people who are fully discretionary, as well as people on the buy side, which would probably be people like yourself in prop roles, as well as in hedge funds, but also people on the sell side, which are market makers. So hopefully that just gives you some context and background as to who I am. At the end of this, we're going to be able to have some questions and answers. I'm going to leave about 15 minutes. So if anyone's got any questions as we're going through this, feel free to note it down or write it, and we can address that at the end, presuming we have time. So what is the purpose of this presentation? Why am I here to talk to you today? And I'm going to start with really just emphasizing it in this way, that I'm here to raise awareness of the how you are as a trader, and the way that you do your trading is more important than what you do. And that may mean a lot. So I'm going to just expand upon that as I go through this. But I'm going to use this wonderful quote, which was taken from the very first Market Wizards book. The trader interviewed was Victor Sperandio. And he said, the key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. And I think that just kind of sums up this issue and the points I'm going to make as we go through this podcast. I'm getting carried away, this webinar. A point which I'm going to repeat later on a little bit is that trading is a performance activity. And I try and encourage everyone to see this. It's not an academic activity. And if you try and intellectualize it, you're going to make the job a lot harder for yourself. Whereas if you try to look at it as a performance activity and try to approach it in that way, you're far more likely to succeed. And I know from the people that I work with that people that come often from performance backgrounds such as sport, gaming, poker, but also, surprisingly, music, dance, the arts, they seem to do a lot better in trading than most other people collectively, because of how they approach this particular work that they do. And in that sense, the performance element is it's not what you do that matters as much as the way that you do it. And just to kind of expand on this a little bit more, there's a lovely quote which I use when I talk to traders, which is, it's not the markets that you have to conquer, it's yourselves. And that really emphasizes this performance element. If you think of a mountaineer, it's not the mountain that they have to conquer, it's themselves. Or if you think as a sailor, it's not the sea or the oceans that they have to conquer, really. It's themselves. The ocean, the market, they're just there. That is the field. That is where they're contesting what they do. But it's themselves that they have to overcome. And this is the very same thing with trading. And the more you can start to actually internalize this, the easier it gets. So this forms some backdrop. But, why is it so challenging? What is so hard about this job? Why is it so difficult? And it's because we are emotional beings. You will hear a lot, and you will probably read a lot that says, try not to become emotional when trading. Well, that's really like saying, try not to have a shadow when you stand in the sunshine. It's impossible. We are emotional beings. Our default operating system is emotional. It's emotions. That's how we make choices. That's how we decide. Everything we do that runs through our veins is related to emotions. And you cannot fight that, and you cannot change that. It's how we roll. It's how we function. And we don't get to choose our emotions. They choose us. And that makes this incredibly tough. And that battle is incredibly tough. And that battle, to win, to succeed, is a psychological battle. It is a behavioral battle. It's an emotional battle. Doesn't matter how intelligent you are, trading is a performance activity. Rather like you can't learn to swim from a book, you can't learn to trade from a book. You go through trial and error, and you try to stay afloat, and you try to swim or you sink. So hopefully that sets a little bit of background, a little bit of context. One of the things I'm going to show you later on is a model which I created, which is taken from my background in trading, but also my knowledge of psychotherapy from my studies there. And it's going to look at the risk process that every trader goes through as they navigate the financial markets and try to manage how they are when they do it. But I want to introduce a few contextual elements first. And the first of these is what I call psychological slippage. And I'm going to just tell you a little story that demonstrates what psychological slippage is, that actually happened to one of my clients during or as part of a coaching process. It was about 6 years ago. I was approached by a trader who worked at a large UK hedge fund, and he'd been there for about 3 years. He previously had worked in a US investment bank for about 12 years, where he'd been incredibly successful. And what happens quite often is these people progress on to hedge funds where they can make a lot more money for themselves. But he was very disappointed with his performance during those 3 years at the fund. He described it as, very mediocre. And he was surprised that he'd performed so badly across those 3 years. Each year he was in the bottom 25 percentile of the traders within that hedge fund. And he knew that he could not last a fourth year there. They expected performance from him, and time was running out. So one of the great things when I got talking to this individual was, he was a really diligent record keeper. He kept records of every trade idea that he wanted to put on, of how he saw the market, of how he thought the market was going to play out, of where he would enter, of how he would exit it, how he would take profit, how he would stop out, or what may cause him to change the structure or the trajectory of the trade. So he had this fantastic record going back 3 years. And I said to him, you've almost got the ability to build a 3-year back test of what you could have achieved because of this track record. So I said, why don't you go and do that? Look back over that time and structure this theoretical what-if scenario. And he did that, and he came back with a graph that really looked a bit like this over the 3 years, where his average performance each year was about 45%, which would have made him by a factor of 3 at least the most successful person in this fund, had he been able to achieve that. The reality was his actual performance was far closer to this. He'd averaged about 4% return per year, as opposed to that 45%, which his method and system and approach should have realized had he been able to execute on all those ideas. And that really led to this concept of psychological slippage that I present to you now, which is that difference between his what-if P&L and his actual P&L. And everyone has this psychological slippage. And I'm not talking about the hard slippage, which is the difference between where you execute, between the bid and offer and the mid price, or the slippage that comes from execution fees or brokerage fees or clearing fees. I'm talking about the slippage that comes from the difference between what you could do based on your system and method and what you do actually do. And that adds up to a lot of money. And the reasons for it, well, if you just look at this image, you'll see a lot of things that you start to recognize on there, I'm sure. These behaviors, and this just sums up a few of them, but snatching quick profits, over trading, sizing failures, self-doubt, lack of discipline, FOMO, listening to idiots on Twitter or people who you connect with, and allowing them to influence you. And these are where they come from. These are all suboptimal behaviors. And that all adds up to a lot of money left on the table. Now, we're always going to leave some money on the table. It's the nature of what we do in this job and the way the job is. Even for this individual, it wasn't the case that he was ever going to be able to achieve that sort of 45% return. That would have been impossible for many reasons. But there was a lot of room to improve. And hopefully this captures that room for improvement. And actually, the following year after this, he returned 11%. So he saw a tripling in his performance. And it wasn't that the market was favorable. The market was actually harder that year. He was, the real measure was that he became the number one performer that year in the fund from having been in the bottom 25%. And 6 years later, he's still there and he's still, knocking the ball out of the park. And we still have a couple of coaching sessions every year to talk about these things. So I hope you kind of get this element of psychological slippage and why these psychological factors are so important and why how you do the job is more important than what you do. Because what you do could be represented in a sense by the green line, but it's how you do it that makes that what you do possible. There's another thing I'd just like to raise. I'm not going to stay on this for now, but we'll come back to it a bit later, is that the trading issues that we're all familiar with it's very common to think of them as the causes of our problems. If I could just get rid of the FOMO, then I'm going to be okay. If I could just go over my self-doubt, if I could just not overtrade. But actually, these issues are symptoms, not causes. And there's a lot of reasons why they're symptoms. They're symptoms of a lot of different factors. I'm just going to mention a few. So, misalignment between your purpose as a trader and your process. Incompatibility, which is not even the easiest word to say, between your process and how you are, your personality. Just merely a factor of a lack of experience and time. If this is a performance activity, we're talking 5 to 6 years to even become remotely competent at it. That's just the nature of any performance activity. So clearly, if you're in the first year or two, you're learning a system, but you haven't got experience in time. So there's going to be a lot of these behaviors you're probably going to be more impacted by. A focus on the what and not the how, which is what we're really here to talk about. Suboptimal processes, insufficient trading education. There's no real syllabuses out there of how to become a good trader. You can learn systems, you can learn analysis methods, you can learn tools and techniques, but they're part of the process. They're not the overall process, and we'll go back to that in a minute. And there's many other developmental factors which are fixable over time. And by the way, with all these symptoms which I've showed you, these issues on here, don't think that traders of 25, 30 years don't have them, because I work with many and they do. They still have them. I think they just have them a bit less. And I think they're just a bit better at dealing with them. And they have some process and structure to get over it. But they all have these still. So don't think they're ever going to go away. But, with time and with development, you'll get better at them and you'll be more robust and more resilient to them, hopefully. So that is the first bit of the context which I want to show you. I want to return just quickly to the idea of trading as a performance activity, not an academic activity, because I want to move on to an analogy now that goes back to performance, which is a game analogy, which I use to try and capture some of the intricacies of trading rather than trying to, as I said before, intellectualize it. And I'm going to build upon a particular analogy of tightrope walking or perhaps walking over a 4-inch beam, and how you develop yourself in terms of doing that. Now, this works out, this is a parallel which works out really well with trading. So let me just move into this a little bit. And I want you to think of that there's two games going on, really. There's the outer game, which is the game that a person does, the game that's visible to everyone, the game that's tangible, the game which is based on technique and knowledge, and the base that can be described. It could be described to an audience or to other people. And then there's the inner game. The inner game is really how you are when you do what you do. And it's largely played inside the mind. So imagine you're first walking on that 4-inch beam, and it's quite easy to do at first. It's 2 feet off the ground, so you're not challenged by it. If you fall, you're not going to hurt yourself. You just get back on it and you practice and you get good at it. It's a little bit like a simulation, I suppose. And before you know it, you can even do a few tricks on it. You now raise that same beam to 200 feet in the air, and your mind gets triggered. Your emotions they take over, and it will change the way you walk that beam. Even if you had a harness on and a safety net underneath, you're still not going to be the same up there as you were at 2 feet off the ground. Your emotions are firing, and there ain't nothing you can do about that. And that's how it is. That's what trading is. And so this game is played inside the mind. It's personal to you. It's hidden from view. No one knows that you're going through it. No one can see it. And often we're actually blind to it ourselves. We don't even know our own inner game. So that brings out this concept of the inner game of trading. I want to introduce another concept you may have heard of. It's the playbook. If you're familiar with with Mike Bellafiore's work, he's written a brilliant book called The Playbook, and he's actually a guest on one of our podcasts in January. And the idea of a playbook is what a person does to execute their actions to help them play that physical outer game, that game against the external environment, whilst managing themselves and their own psychology, behaviors, and emotions in their inner game. So you're really playing those two games. They're facing both of them, one against the market and the environment, one against yourself. And the playbook, it really kind of defines your strategies, your tactics, your approach, your rules of engagement, guidelines and principles. And each trade that you take should be a game plan that's derived from or in line with your playbook. Now, I don't want you to think of a playbook as a physical representation that you have on your desk that lays out all your plays. It mostly exists within your mind, and it's emergent and changing over time. But there is a certain set of plays that will work for you, and styles and approaches that form your playbook. I'm going to move on to this in a minute, this trading process cycle, which is the real meat of this presentation. But before we do, I want to introduce this idea, this concept of 3 lenses of a trading practice, because it helps build this story that we're going through in this presentation. And I want you to think of the first lens as being a knowledge or technical lens. This lens is a focus on what a trader knows, your understanding of markets, product knowledge, trading knowledge, and analytical knowledge. The component parts that really contribute to value and idea creation. This is, in a sense, this is the green line that I showed you on that graph before with the hedge fund trader. The what if P&L would be formed from this technical knowledge. And this is, in a sense, the what you do of trading. The second lens is the risk process lens. This is really where the performance happens. This captures your risk philosophy, your risk attitude, the way you monetize your ideas, the way you monetize that knowledge and technical know-how, and turn that into gold, for want of a better word. And then there's the third lens, which is the self lens or the self-management lens. This lens is very much about who you are and how you manage yourself through the stages of both the analytical process and the risk process. And by doing it well, that enables you to excel. So you've got these 3 lenses, and you can see them collectively on this image. They combine and they overlap ideally. And the overlaps are really interesting areas. The first overlap here is the self-management knowledge lens overlap. And if you're strong on this overlap, if there's a strong overlap, you're able to be fluid in your analysis, objective in your assessment, creative in how you come up with ideas, and you're able to see situations clearly and with coherence. It's possible to be objective here and come up with really strong ideas. The overlap of the red and the blue lenses, the knowledge and the risk performance lens, a trader strong on this overlaps is then able to take those ideas and monetize them effectively. They do it in optimal ways. They size well. They put the risk on well. They manage the risk on well, and then they exit that risk well. So it's really about taking the ideas, taking the information you have, and monetizing them effectively. And then this final one is really about how you manage yourself through that process. If the risk process is the monetizing it, the more the overlap is, the stronger your self-management lens, the less likely you are to be owned by the market, and the more likely you are to own your own trading as you go through that, the more optimal you will act, the more you will stay on focus and course, the more you will execute a good trading process. And then there's this middle ground, which is really all of those three lenses and all those three overlaps combined into one if you have a strong overlap here. And this is where peak performance really starts to happen. You could play offense and defense in one single move, because that again is part of all performance activities, the ability to both survive as you do something and thrive at the same time, to stay above the fray, to not give away your money, to not suffer dramatic drawdowns, and also to find opportunities and to take advantage of them. And this is what great traders do. This is what masters do. This is where peak performance comes. And hopefully the more balanced these are, the more they can converge over time, and the stronger you become as a trader. On the other hand, you get this situation quite often, divergence of the three lenses, where someone is very strong on one area, but weak on the other one. And this is the situation we see the most. A lack of harmony and balance with an over-focus on the technical and the knowledge element, and an under-focus on the risk process or the self-management lens. And this is very, very common. And this is the cause of a lot of failure here. I go back to my own trading. Sometimes many years ago, if I was in a challenge period or a period where I was struggling, I'd actually lean into my knowledge and my technical know-how a little bit more, rather than focusing on developing my risk process or managing myself. An example of that might be, the more I'm struggling, the more I do analysis, the more research I do. When actually that was the wrong way to do it, and I'm actually making it harder for myself. And I would end up in a situation where you might be familiar with analysis paralysis, that term, where you do so much analysis that you just can't see the wood for the trees. So this is a really good example. And, this is where a lot of people have problems, this over-focus on knowledge, where, that falling back on where do you think the market's going rather than how can I trade this better? We all do that. We all think, where do you think the market's going? It's the wrong question. How can I trade this market better wherever the market goes? So without balance and harmony, as you can see there's an absence of mastery, that overlap in the middle. If as long as you stay like this, peak performance is going to be more and more elusive to you. And also, if you allow yourself to go like this, as I said, when I was talking about those times, I was a senior experienced trader. So sometimes you're in balance and harmony, but other times you go out of shape and you go towards this and you kind of lose your edge. So senior traders themselves will lose their touch and they need to get it back. And this brings me on now to the core, the meat of this talk, the trading process cycle. And just to give you a little bit of background to this, it's something I developed during my time coaching. It is a tool which has evolved from a particular approach within psychotherapy, which I've adapted it to markets. And it's really a way of looking at how you navigate that journey through the environment that you're in or the challenge you face in the most optimal way whilst maintaining balance yourself. It's not going to mean very much to you as you look at this. So I'm going to try and describe it with some stories and a particular story of a particular trade. So I want you to imagine the starting point for this journey. So imagine this represents a single trade. And the starting point would be that you as a trader are a completely blank sheet. You have no views on the market. You have no biases. You have no beliefs driving your trading. Let's just imagine that you decided to take the whole of 2021 off. You disappeared. You traveled around the world. You didn't look at the market. You didn't read newspapers. You didn't follow any stories. You didn't speak to anyone in the markets. And then you walk back in on the first trading day of 2022 and you're back in the market with a completely clear head. And the first thing you do as part of any process is to clarify your purpose. Why am I here? And what am I doing? And what am I doing this for? You have to know your purpose. You have to know your reason. You have to know your rationale. And you have to have a clear purpose. So your purpose as a trader, normally, a typical one would be, you're here to make money, or you're here to produce a return on capital. And you're here to do that whilst also trying to minimize drawdowns, minimize losses of your capital. So you're trying to build and grow your capital over time. And you're trying to do that by taking risk based on ideas and approaches you have to the various markets you trade, and by executing that effectively. So there is your purpose. And I'm sure most people's purpose isn't too different to that. So that sets a template even before you start. Then the starting point is this, represented by this green circle. So the cycle started at the 6 o'clock position, purpose clarified. You've been away, ideally, you've been away for a year, you are a blank sheet of paper. There is no story on there. There is no beliefs. This is a lovely way to be. If you can be like that, fantastic. Of course, it's an ideal, but it is how you should be. And then what you're going to do is, as a trader who's been away, it's going to do what all of you do. You immerse yourself in the market. And when you do that, you start sensing and scanning. This is a psychological process, which you just happen to do by being in the market. And it's a little bit like having a satellite dish on your head, and you are just looking around and observing as much as possible. You'll be observing price action. You may be reading some research. You may be reading some analysis of the markets that people have produced. Maybe Capital.com have sent you some decent analysis, which you're trying to make sense of. You'll be talking to other traders. You'll be looking for stories in social media that lead you to places. You'll just be immersed in the market. And but by being a clean sheet and having no beliefs and no bias, you will be able to do this thing, which is something that the very best traders do. It's called practicing detached curiosity. In other words, you're looking for something and you do it without attachment, without a belief, without a bias. So you can be as objective as possible when you're looking at the market. You don't have an opinion to be bullish or bearish. You know, if you think the stock market's always going to sell off, you know, you've got a huge bias already. You cannot practice detached curiosity. If you're sitting there with a trade that you're just running and it's not working, you're not going to see things in the same way. You're not going to be that blank sheet. You're going to struggle to practice detached curiosity. You're not going to be as objective as you can. So that's a kind of state that you start off before you even get going. And as you're doing that, you start to become aware. You start to feel things. You start to sense things. You get a feeling or a prompt that takes your curiosity somewhere. So you may be looking at, say, the S&P, and you may be thinking, yeah, I fancy this higher from here. I think that there's upside here. Or you might be thinking, I fancy it lower. You know, I've got a sense that it's overbought. It's, you know, it's bounced. It's hit a level. It's come off again. And actually, I think we're going down. Whatever it is, something has triggered your curiosity to a deeper level. And now you need to really do a little bit of more digging. So you start doing this thing called sense making. You've sensed something. You now want to make sense of that feeling, or you want to make meaning of that feeling. So you start looking a bit further. You start asking other people. You read more research. You zoom in on this particular issue. Maybe you look at the charts. Maybe you look at some moving averages, some indicators. Maybe you're looking at market profile and you're playing around with that. As you're doing that, you're starting to really formulate some value creating ideas. You're not ready to trade yet, but the idea is taking shape. And that's where this blank sheet of paper now starts to fill out. You have a story formed. You have a narrative formed. You have a belief formed. You're starting to build a map of where you want to go with this, of where the market may go. And that is this first bit. You form narratives. That's what you do as traders. And in doing that, that is what you're thinking, can I take this to market? So there's a point now where you're going to move to action. You are going to act on this, whether you trade on it or not. not trading is an act as well. You're already engaged with it. So you need to know, do you act? Do you not act? Do you hold off? How much to do if you're going to act? Is it worth the act? These are the questions you're going to ask yourself. And this is this part here. And this part here is very poorly understood. And it's usually very poorly practiced. But this is how you mobilize towards action. This part, as I say, is poorly understood. Often what happens is people rush to action. I've got an idea, boom, buy it. Well, what's the risk reward like on this? Where's your stop? How much are you going to put on? Where are you going to get out? What might be the what if scenarios? Are you acting out of fear? You've got the idea, but you fear you're going to miss it. So you just act straight away. What are the reasons you put on? Is it aligned to your purpose? Are you putting it on because some other person wrote, some idiot said on Twitter, this is the greatest buy ever? You don't even know if they're a real person. We often put things on for the wrong ideas. Your purpose has to be that you find trades, you find a reason to trade, and then you align it to your playbook. So this part here is really about constructing a game plan that is in line with your playbook, that is in line with the terms of engagement, the strategies and tactics, how you allocate resources. Your playbook comes in here. As I say, it may not be fully formed, it may be evolving, it doesn't have to be written down, but pretty much you have to have a set of rules and principles and guidelines which at least give you some structure to where you're going with this. And you want to be following that. If you're not following that, if let's say you only buy when it's above a certain moving average, or you only trade a certain type of day, but then you go completely outside that, then you're not helping yourself. You're giving into this. Or if you act because somebody next to you has bought it and you don't want to miss out, you don't want that person to make money, and you miss out, well, then you're probably buying for the wrong reason. If, on the other hand, you're buying because the person next to you said, I've got a really good idea, I've been following this, I'm putting this on, and you think, well, I've followed this guy for a while, I'm thinking it anyway, I know he's pretty good, that's okay. We have to sometimes look at the context with all these decisions. The action changes it. The action is the bit where that 4-inch beam is raised from 2 feet above the ground to 200 feet above the ground. The act is on, the performance starts. Enter stage left. Your trade entry is the start of the performance. Your gameplay is now active, but you will be different. You will be emotionally triggered, or at least sensitive to potential setbacks. You'll feel great when it moves up, or you might feel lousy when it moves up because you never actually put it on, which may then cause you to put it on, but not within a game plan and not as part of your playbook. So that there's a lot going on here. And this point here, you are in full contact with the environment. Your performance is being watched. Even if no one else is watching it, you feel it is because you are. You're watching yourself. You have expectations of yourself. You're judging yourself. And then the performance closes. This is the end of the trade. It doesn't always mean trade exit. You may just think you're going to stay with it and it's to be continued, and you'll think what to do on another cycle next time, what to do with it. And if you decided not to act, you're still engaged with this bit. You don't get off, because if you decided not to buy the S&P and then tomorrow it's 100 points higher, you're going to feel pretty crap about that. So, you still are impacted by the fact that you didn't trade. And then we move to the final physical part of the cycle. You've exited the trade. That need, which started at the 9 o'clock position, is now fulfilled. Even if you didn't get a good outcome, it's completed. And this is where shit gets real, to pardon my French. You either had a good outcome or a bad outcome. It's only one of two. And you may not even judge a good outcome as a good outcome because you may have expected better. And you may not judge a bad outcome as a bad outcome because you may have got yourself out of a hole. But in some way, you are going to pass judgment on how you did. And the most important thing at this stage is getting closure and letting go of whatever happened. This is the key: avoidance of resulting and acceptance of outcome. You have to accept what happened, whether you liked it or not. And when you can do that, you can get closure and let it go. I'm going to tell you a very quick story of a client of mine who's a very successful commodities trader, 20-year veteran of the markets, very aggressive trader. In the summer, he had a trade on all year, a particular trade that he was looking for an outcome. It was a call option trade. Now, he has a principle, and one of those is that he flatters his book before his summer holidays. He takes a month off in the summer, spends time with his family, doesn't want to be looking at the market, doesn't want to carry any risk. So he flattens his book at that point. Now, what happened was this particular commodity market absolutely exploded and soared. He would have made more money in that week than he would have made on any particular 1 year. Now, when I met him after the summer and he told me this story, he spoke about it in such a matter-of-fact way, like he was talking about someone else. And I'm a little bit like, okay, you don't sound too disappointed in this. And he said, look, Steve, I was hugely disappointed. You know, unfortunately, it happened. There's nothing I can do about it. You know, my rules are my rules, my principles, my principles. If I didn't have them, I wouldn't be here today. So that's more important for me, that I stick to them. So I can live with that, he said. And that's how he gets closure and letting go. Now, that is incredibly hard to do, but it means that he can then move on and he's not carrying that baggage around with him into the next trade. He's not playing the regret game. He's not doing revenge trading. He's not trying to make back the money he didn't make. He's taking the next trade for the right reason that's in line with his purpose. So once you can let go, you can then leave this cycle and move on to the next cycle. And there's a process here where you have to reset. Between every cycle, you have to reset, and then you get back to getting in line with your purpose and starting the next one again. And these cycles are variable, and you can have multiple ones going at the same time. If you're a short-term trader, these cycles can exist in a matter of seconds. If you're a long-term trader, it could be weeks or even months. And you can have cycles within cycles. I don't want to overcomplicate it at this point, but I do want to explore some of the features of it. So obviously, clarifying purpose is really important on every single cycle. But the biggest edge is this: closure and letting go. Getting mental closure. This is the super skill which, with all the amazing, highly successful traders that I have met, that had longevity in the markets, or that I have coached, and I've coached some incredible traders. 3 of them were featured in the last Market Wizards book, which was published last year. One of my traders this year one of my clients has been voted best hedge fund manager in Asia and best long short fund in equities for the past year. I've got a lot of clients that are really superstar traders, and I noticed this ability within them. Their ability to close and let go. And it sounds easy. I promise you, this is the hard thing to do. Most people, even good traders, are pretty lousy at this. No one is perfect at it. Everyone slips at times. The best people I would rate 7 out of 10 on it. Good traders, most good traders, 4 to 5 out of 10 on it. Pretty much everyone else somewhere in the 1 to 3 out of 10 area of it. This is the super skill of trading. Now, I just want to put some emphasis on this, and I'll try and hurry because I'm sure we want to get a few Q&As in there. You have to complete the cycle. You have to go round. You can see where the lenses overlay onto the cycle. The upper half of the cycle is mostly about the doing action. It's really about action. It's the doing. It's the tangible process. It's the outer game, is what you visibly see. The lower half of the cycle, this is mostly non-conscious processes and being. Left-hand side of the cycle, this is pre-game analysis and planning. The right hand is actually the performance, how you are, what you're doing, and of course your post-game reflection. You can also look at it in this way, where the cycle itself is a boundary between you and the external world. And there's always information crossing that boundary from the external world, affecting you and how you are in the internal world. Now, completion of the cycle, the full cycle, is essential always for good process. And when you do that, you create a growth spiral. This becomes a source of good behaviors, good habits, good ability. This is a virtuous process. If you fail to complete cycles or you shortcut them, it produces stagnation and decline and is a source of a lot of problems. Now, a few quick examples of short-circuiting the trading process cycle before we wrap up. Example 1. So in this action, a trader has exited a trade and then he's rushed straight back in without going around the risk process cycle. He's not thought about what he does. He might have been stopped out on a trade, then the market bounced, then he said, I knew I shouldn't have been stopped out, goes straight back in and buys it again. Of course, he's got no plan for it. He's just reacting. The original plan was if it hits that stop, you get out, you let go, move on, decide what to do next. Nothing wrong with going back in a trade as long as you go around that process. Should I go back in? Where should I go back in? At what point? So what often happens when you do that is you start getting yourself into a negative action loop. You get lost, you go round and round, and before you know it, you're on tilt. And once you're on tilt, you're in trouble, because that really defines a lack of closure, a lack of letting go. We start getting self-judgmental, we start beating ourselves up, we undervalue ourselves, we start looking to blame others, blame our broker, blame the analysis. We're angry, we're full of regret, really unhealthy behaviors. Decline and stagnation. The second example, this is where you actually had a good outcome. In this example I'm showing you, maybe a very good outcome. And you don't actually seek closure. What you kind of do is you think how brilliant I am, how amazing I am. You can't get your head out the door. You know, you want to tell everyone on Twitter how much money you made. And that's the beginning of a disaster usually. It's the slow seed that leads to the next big problem. You know, I've been there many times in my trading. You know, my best ever year was followed by my worst ever year. And the reason was I thought I knew what was going on. I thought I didn't need to listen to the market. I thought I know where this market's going. So I'm not getting closure and I'm not clarifying my purpose. I'm not sensing and scanning. I'm just rushing straight back into the next trade as if I somehow know. And I'm doing it without a really strong objective structure behind me. And that becomes the process is now based on a shaky foundation, stagnation and decline. Example 3. This is where maybe you've got a good system, but it produces a run of bad outcomes. Now, it's quite possible that system or your method or process does have bad outcomes regularly, depending on what your method is. But you might have a run of 2 months without making money, and that might be quite normal for your process. Maybe the markets aren't being particularly kind to your system, but you know over time it produces a good result. You have to stick with it, and you have to stay with it. But what happens is you're getting angry, getting frustrated. You can't let go of this bad run. You're seeing your P&L drop, and you start resulting. You start thinking, I'm going to change the way I'm trading. I'm going to trade outside of my system or my method. So you don't get closure. You don't let go. You rush straight back to the next one. You start sensing and scanning, but you're carrying this baggage with you. And the next time you trade, you change your plan of action. You abandon the system, and your trade entry is now faulty. You're trading on a lack of process. You're just making it up as you go along, and your performance suffers. Your old system, on the other hand, starts kicking in. It starts making money again. You may not even be aware of it because it was always going to kick in at some point, and that maybe even adds to your frustration when you become aware of it. So again, we're seeing this happening. Just want to emphasize this point. Many traders are very quickly strong on knowledge, technical know-how and analysis, but they're challenged on the risk planning, the risk management, the risk ability, the entire risk process. And you end up with this. This is often what's happening. So really, just very quickly, the purpose of this presentation It's to raise awareness of how you are as a trader, and what you're doing when you're doing it is not as important as how you are and how you manage yourself as you do it. Just want to repeat this point here. The key message to take away: it's not the markets you have to conquer, it's yourself. Now, I think we've got about 10 minutes, so I'll try and answer some questions if anyone's got it after this. If anyone wants to put any questions in there, in their box, or if they want to ask me anything at all from anything they've heard, feel free to fire away. I hope this is working.
I think we do have some questions, Steve.
Okay, all right, fire away.
So Tushar's just said, is it possible to get a PDF of this PowerPoint? Just to comment on that, we will have the recording of this and it will go on our YouTube channel. And if you want it directly sent to your inbox, then you can message your account manager and they'll be able to send you the link directly. Now, the second message is from Chester. It says, thank you, Steve. That was great. It's really going to help my trading process. Do you still actively trade?
Yeah, I should do, but I do, but it's a hobby. I don't do it for a living. I haven't done it for a living since 2010 or 2011. I checked out for it as a living when I became a coach. But it's very hard to ever stop, and I do still trade. I love it. It's just a bit of a fun account. I call it fun money. It's certainly not for a living. It almost doesn't really matter whether I make or lose money. But yeah, I do, and I'm glad to say that it becomes easier when it doesn't matter, actually. So yeah, I still do it a bit, but you know, they're occasional trades. I don't think I trade the same way if I was trading for a living.
Perfect. Has anyone else got any more questions? You can put it in the chat. We've got one more question. I'm interested in trading, but I need help. And I need a mentor as a beginner. So where would you suggest to start as a beginner?
Oh, it's very difficult. I mean, you may even find, I don't know how Capital.com work, but whether you have any mentoring networks. You know, some of the people I know have kind of associate relationships where people almost mentor each other. You know, you can learn more about trading by teaching someone than you can from just about anyone else. So I know quite a few people who have these almost buddy partnerships with people, and they talk every now and then, and they find it really constructive. Good mentors are the best thing you can ever have as a trader, but they're really hard to come by. You know, you normally have to pay for a mentor. The ones that you pay for are, you know, it depends what you want as well. You know, do you want someone who's going to teach you? If you're in your first year, you want to be learning the basics. You actually want to be learning what to do at that point, and also looking at how to do it and really focusing on that as well. But you know, are you going to learn a system? Do you want to learn technical analysis and do your own analysis? Do you want to learn fundamental analysis? You know, do you want to learn something like market profile, which is hugely valuable for, you know, for short-term and day traders? There's a lot of great resources out there, and you know, there are people who are going to show you systems, but they're only going to show you the system. They probably won't actually teach you how to trade. But some of those systems are really good, and it's a starting point. You know, it's a bit like anything. You know, if you pick up a tennis racket, you've just got to start playing tennis. Or you pick up a guitar, you start by learning a few notes, maybe watching some videos, maybe having some simple lessons, and see if you like it. You know, it's a performance activity. It's the same as learning as that. You know, create a simulation account. I prefer people who create real accounts, put a bit of money on the line, so you get a sense of what it really feels like. It doesn't have to be big. You can trade it. You can literally trade with pennies in some places. I don't know what resources you have at Capital.com for that.
Yes, so we actually, you know, each client gets a dedicated account manager. So when we do call you and we send you emails, you know, we are here to help you trading. This is like the whole point of, you know, us giving you this webinar by Steve as well. It's, you know, we're here to help you improve as a trader. So give us a call, send us an email. Let's schedule a call together. You know, let's go through your strategy. We can talk through the markets. It's all non-advisory, so we won't be giving no advice. But in terms of helping you become better traders, we do have a free trading course you can do, and it is available on the App Store and Google Play. It's called InvestMate, and it is on our website as well. So if you want to find out more information, you can go to the website, or like I said before, message your account managers, and we are here to help. So I've just got a few more questions, if you don't mind, Steve.
Yeah, sure, fire away.
Someone's asking, how would you make a start to the transition and letting go of your emotion trading mode if you're fairly new to everything?
So that's a great question, isn't it? In a sense, we're not talking about letting go of emotions. It's almost accepting your emotions and being more conscious of them. Letting go becomes easier if you have a process, if you have a structure. So that particular individual I was mentioning before has a very clear process and set of rules, and it becomes far easier to let go if you have that. And you have to accept that this isn't a perfect. There is no perfect in trading, and it almost becomes starting to give yourself some basic principles and basic realities of trading. You're aiming to get better. You're not aiming to be perfect. You accept that you're going to make mistakes. You accept that the market is uncertain, that you can't possibly know what's going to happen, that you could tick every box in your system and still lose money. It's a bit like playing poker. I tell a lot of people to learn poker or learn bridge. Two great games that are really very similar to learning trading. And, we get a lot of successful traders who have played poker because the mindset is so similar. And when you play poker, you've got to learn to let go. You can sit there with a great hand, and then, a lot of money goes on the table, you get nervous, you fold, and then you found you would have won. That could be devastating, but you've got to let go of that and come back to the table the next week. And you've got to do the same with trading. And sometimes it can take a long time to let go, and you've got to take breaks. You've got to get your mind back into it. It's really, that is the art of anything, and it makes it easier to live with the emotions, to be able to separate them and divorce them. But, I don't think it's ever easy. As I say, I still have, 25-year, 30-year veterans, throwing things across the table because of the things they do and their annoyance with it. But it's like they return the next day as if it didn't happen. They've really learned to deal with it. You're always going to do that and accept that, but you just want to be incrementally getting better at it. I don't know if that's the answer you wanted, but there are no simple answers to it.
Thank you. So I'm just going to end on this comment from one of the attendees. Just says, I'm a total beginner. I just want to say thank you for this knowledge. It's really great foundation to take and implement on my trading. Thanks again, and look forward to trading live.
Oh, you're welcome. Listen, I love doing this. I love this job. I love trading. It's a fantastic journey. Try and learn how to survive first before you really learn how to thrive. Otherwise, you're not going to survive that trading journey. At the same time, paradoxically, you need to take risk and not be afraid of it. For that reason, really learn the process, learn how to do it first, learn what you need to do, learn how to be, and it'll be a great journey. And those who make it can, they can achieve extraordinary things.
Thank you, Steve. So we'll wrap it up there. Just want to say a big thanks to Steve for coming out and, sharing his experience with us. And we will have the recording. It will be on the YouTube channel. And like I said before, if you do want it, we can send it to you via email. Just get in touch with us. And, we look forward to bringing you more content like this in the future and having Steve back on again.
Thank you very much. Thank you, Chris, for having me.
No problem at all.